All right. Hey, everybody. Jeremy here coming at you for the market bias update report for September 24th. This is Sunday evening. Futures have been open for a little bit here, and we are starting to see just a tiny bit of reprieve from last week's carnage. We had Federal Reserve J Powell uh, basically speak on Wednesday and said higher for longer, continuing that chant. And basically, the market did not like that, and also did not like the fact that the Federal Reserve projected now that they are not going to start cutting rates anytime in 2024 is kind of the new expectation. Previous to this candle on Wednesday, the market had been anticipating and predicting that rates might start getting cut as soon as June of next year. So obviously, the higher for longer chant that the Federal Reserve has been putting out for a while now finally had some statistics to back it up, and the market just hated that. Oops, excuse me, hiccup there. So anyways, we sold off on Wednesday, Thursday, had a little bit of inverted hammer candle on Friday, which is a slowing momentum candle, so that was nice. It was on heavy selling down here on our volume chart. MACD is obviously bearish here. Both signal line and the MACD line are underneath our zero. It looks like we're getting some slowing momentum in that. So I'm actually looking at this right now. And at least as of now, today's candle development, in addition to the inverted hammer candle that we had on Friday, tells me that we are probably overextended enough to the downside that we will likely see a little bit of a snapback here. The depth of this snapback is up to be determined. My guess at this point, base case, is it coming back up and touching the decreasing 9-period moving average right there. That is about 44.23 currently on the daily chart. And then that'll be kind of the decision line. If we high base there for a little while and can reclaim it, we might have a little bit more upward momentum to go. Honestly, the more likely outcome is that we snap back up somewhere between here and that decreasing 9, and then end up rolling back over and retesting the support zone at 43.50, which we almost dinged here. That was the projection to the downside from either last week or week before last if we did end up breaking down. I believe that was last week. We were projecting if we did break down from this base right here, that we would end up potentially coming back down and testing the lower range there. If we throw this out to a weekly chart, it gets a little bit more bleak. We do not like being below the 9 and 20 on the weekly chart. We did close below that on Friday of last week. This is last week's candle here. And it does look like, unless we get some really bullish action, which I'm not really anticipating off the lows here, that the 9 is going to cross over the 20 here in blue, and that is also a bearish indicator. Looking at the weekly chart here, if we do break that 43.50 zone, we do have a little bit of history down here at about 43.20. That corresponds with kind of the pivot here before a gap up, and also back over here, the pivot high from late last year. I think it was like October of last year. So anyways, there is a little bit of a support zone there, but honestly, if we break that 43.50 level, I don't think that 43.20 level is going to be enough to hold the market up. And at that point, we are probably looking back down to about 4,200. That is the next real solid level of support. So unless we get some good news coming out on the economy and global economy, some of the strikes that are going on in the automakers right now, there's just a lot of negative news right now. So unless that changes fairly drastically in the first few days of this week, I am anticipating further downward motion here and probably a break of that 43.50 level, and then targeting down to about 4,200 on the S&P. So keep an eye out for bearish trades. Keep an eye out for snapbacks where you have a little bit of bullish action to start the week, and then it rolls over and gives you a nice bearish entry. That's going to be the name of the game this week. Going out to crude light. And let's drop this into daily here. So crude has just been on an absolute monster tear. We are finally getting some cooling off on that. I do not anticipate that cooling off to last. I fully anticipate us coming back up and testing the $93 mark. And if we do break above that $93 mark, I am anticipating us probably pushing back up towards 100. I'm trying to find the time frame that shows that. So coming back up towards 100, kind of up towards the highs from back here in August of last year. That would be the next target if we do break out of that 93 level. Not really concerned on the pullback. Honestly, I would love to see this pullback and come back down to the rising 20. Hopefully let that take a couple of days and have the 20 continue to rise here and come up to around the low of this doji candle the last time we had a pullback a few days ago. And that would be somewhere around 88.50. So looking for some more consolidation here. I would love this to just chill out and go sideways for a little bit, and then give us a clean entry on a break, potentially above 93, moving towards 100. Going out to Bitcoin. Nothing really to see on Bitcoin. Still a mess. Still has a ton of overhead resistance here. If we do get a pullback continuation here down to the daily 200, that also correlates to a support level on the weekly chart, just under it there down here at the 50-period moving average on the weekly chart. I would potentially be interested in seeing it come back down to around that 2,500 mark, chilling for a couple of days, and then moving higher as it breaks our diagonal resistance here, this green line. I might be able to get talked into a conversation around potentially picking up some Bitcoin proxies or Bitcoin itself if we get a pattern development here. But right now, this needs to clean itself up a bit before we start really discussing that in detail. If we go out to gold, gold is really interesting to me right now. Sorry for my voice cracking, guys. I just got back from a music festival actually, where I was whooping and hollering all weekend, so my voice is quite raw. Gold is very interesting, and the reason that this is interesting, as I've said in previous weeks, is it has actually held up pretty dang well. It has refused to give up this daily 200-period moving average. It has held that strong in spite of the US dollar just being on a 45-degree angle up, just straight up trajectory like that. And we need to see this chill out, one, for the overall market, but two, if this does chill out, which I am expecting it to here soon, because you can't stay overextended like this forever. Momentum does not last forever, and this has been overextended technically since beginning of August. So a couple of months now, basically, that this has been reading as overextended and really needs to get pulled back here. That is tied to the euro slash US dollar. There we go. The US dollar. And let's put this on a weekly chart so you can really see what's going on here. So the euro has been weakening. It has come in finally to a little bit of support here, this purple line, and is fighting right now to try to hold on. If we get a confirmation back above the high of last week here, somewhere around 107.33, we still have a ton of resistance with moving averages and stuff, but if we can take a couple of days, work back up to that, give a little base and break higher, that will really help to pull the US dollar UUP back down, break this strong diagonal trend that has been having, and give some reprieve to not only the market, but potentially a significant pop on gold. So gold, like 90% of gold around the world is priced in US dollars. So if the US dollar is higher, other countries and other demand have a harder time with the exchange rate to the US dollar to then buy gold. It becomes more expensive for them to invest in gold, which is why it's kind of inversely related here. So if we do see a pullback in the US dollar, we should see a break of this diagonal line in gold, and that could end up being a really nice potential trade back up first to about 2025 and then ultimately back up to about 2085, back up to the pivot point on both of these highs from the last 3 years. And that would be a very, very nice trading environment. Going out to natural gas, really nothing to see here. We have continued to track this reversal. I do fully anticipate that we are going to break out of this range to the upside at some point. But it has been taking its sweet, sweet time. Had some massive volatility in it the last couple of weeks here with the week basically opening and closing very tight range, but having these wild whipsaws back and forth between the bears and bulls, trying to figure out who is going to win that fight. It would be really nice actually if this would just chill out a little bit longer, allow this 200 period moving average to continue to converge down to about 280, and then to see a break above that with a confirmation back up about 287 or so. A break above that I would be willing to play. So keep an eye continuing on natural gas as it bottoms. Going out to the NASDAQ. Ugly chart, very, very similar to the S&P. We are having lower highs and lower lows in the MACD, signaling downtrend and potentially more pain to go. Just like the S&P, we had an inverted hammer candle here, and we are probably going to see a little bit of a snapback up into the decreasing 9, and hopefully we'll stabilize there. But chances are we probably will roll over, and I anticipate at least testing the low of the doji here from 8/18, August 18th. That is kind of my base case that we are probably going to touch that at some point here. If we toss that out on a weekly chart, you can see the weekly chart, just like the S&P, is kind of ugly as well. We have the 9 and 20 converging just like the S&P. We are in a downward trend on MACD. High selling volume the last couple of days to close the week. So again, weekly kind of confirms the potential for a little bit of a snapback and then potentially a rollover if we don't get some follow through to it. So keep an eye on the NASDAQ. And that's actually a good segue before we finish off the rest of our talk here on the major indices and commodities. Let's go over to the 1 week performance here on our FinViz heat map. And you can see technology, which we were just looking at, ugly shape. Microsoft down 4%, Adobe 3%, Nvidia over 5%, AMD over 5%, Google over 5%, Amazon over 8%. Tesla got smashed for almost 11% down. So heavy selling in the overachievers thus far this year in the tech space. And the interesting part is right now on the heat map, you can see there is very, very little green anywhere on this chart, except for up in healthcare in the upper right corner up here. And that tells you that the selling is coming out of tech, but it's not rotating back into the market. People are taking profit and moving to cash. So that is not a particularly good sign for the health of the overall market. And that tells me that this might be a short or intermediate term top. And then we might see some more pain starting to develop here in the market going into the rest of the year. So keep an eye on that heat map and check to see if you do see any rotation of money or if it is just straight selling across the board and people rotating back into cash. Going out to the Russell 2000, still in this massive range that we've been tracking for the better part of 6, 7, almost 8 months now. Base case, similar to the NASDAQ, similar to the S&P, a snapback up into resistance and probably a rollover and retesting this 1700 line one more time. If we do get down there, I will be looking at that as a potential buy, given a good pattern development, like we had this nice big W here last time. But this needs some time to clean up. Any bullish momentum here, I'm going to look at very skeptically until we cross above and close above not only this diagonal resistance, but also the 20 period moving average here, which is up at about 1876. If we do close back above 1876 and can stabilize there for a little bit, I would be willing to play to the bull side, but my base case is probably more pain to come on that as well. Finally, just wrap up, guys, looking at silver, very similar conversation to gold. It has actually held up really, really well. Given what's been going on in the market, you wouldn't even really notice that there's any real volatility here in silver at all, especially on the weekly chart. So that looks really, really healthy to me. We did have one day that things kind of freaked out Wednesday evening and then Thursday during the day after Jerome Powell spoke. But other than that, recovered, got the 9 again, and is now just hanging out here and waiting for a breakout. So silver looks good. Finally, last but not least, guys, let's go out to our economic calendar and just look at a couple things coming down the chute this week. Nothing really going on tomorrow for Monday. Consumer confidence will be important on Tuesday. New home sales will also be important on Tuesdays. Keep an eye on both of those. The final GDP and unemployment claims will be important this coming week. Federal Chair Powell, unfortunately, is going to speak again on Thursday. Honestly, I doubt that's going to move the market much because we just got an update from him this last Wednesday, and pretty much everyone knows very clearly now what his thoughts are on the market, and what the Federal Reserve in general's thoughts are on the market. So nothing really is probably going to change between Wednesday last week when he spoke and this Thursday. So I'm guessing that's going to be kind of a wash. And then on Friday, keep an eye on core PCE and revised consumer sentiment as well. So those are kind of the economic pieces that are heading our way as traders. Anyways, as always, let me know if you have any questions, guys. Trade safe. Look for bearish retracements that you can trigger into the downside, and keep your stocks stop losses on. And if you do trade options, it might not be a bad time to buy some insurance or some put spreads on some of your long-term stock positions. Protect yourself from potential downside. Looking at the VIX right now, protection is still relatively cheap, especially if we put this out on a weekly time frame. The VIX volatility indicator is kind of a rough guide to option pricing. As volatility spikes, options get more expensive to purchase. So since this has been low for a while here, we are starting to see a spike, and I anticipate that to continue, especially with this kind of double bottom rounding pattern that we have on the MACD here. I am expecting that we are going to see some significant volatility and wouldn't be surprised to see the VIX double here back up to 30. So if you're going to get insurance on any positions, now is probably the time. Hope that helps, guys, and I will see you next week.